position where we can start building up a framework from the various elements that we've previously discussed. Let's have a look at the diagram. Let's imagine that you are a manager, a decision maker at this company. And down the bottom here we have an investment. Let's say the investment is $100 million. So we build a financial model where we identify the free cash flow, that is the investment going in initially, and then the sequence of cash flow returns that will come to the company over a relevant period of time. In other words, the free cash flow. If we have the free cash flow, we also have the return on capital, and also we have the IRR, because if you remember in a previous clip, we identified that free cash flow, return on capital, and IRR are all different expressions of the same thing. Now, for the moment, I'm going to call it the return on capital, the ROC. Now, when we say capital, what do we mean? Do you remember when we discussed risk, we said that there are two concepts of risk, and what we should have in language is two different words. Well, capital is the same. There are two concepts of capital. If you have an accountancy background, I am fairly sure that you will have the narrow definition of capital. One of the accounting captions is called issued capital. And so it could be that you have in mind shareholders' equity. And sometimes when we talk about capital, that's exactly what we mean. But when we talk in corporate finance about return on capital, cost of capital and such like, that is not the meaning we are ascribing. It is the broad meaning of capital, by which we mean all sources of funds on which a return needs to be generated. So it means debt, equity, and everything in between. Preference shares, convertible bonds, senior debt, junior debt, leasing, short debt, long debt. Bracket it all together, call it capital, and this capital has associated what is often called a cost of capital. And you see that when you see a company drawn this way, it becomes immediately obvious why we have companies. All companies are conduits for capital. Capital comes in one side and it goes out the other side. And the only reason that we need companies is to provide an active focus for the management of that capital. These people here, decision makers who work at private sector corporations, these are what I call active managers of capital. Whereas bankers and investment managers up here at the top are what I call passive managers of capital. A bank manager would die of fright if he was put in charge of a cement plant with 1,000 employees. He wouldn't know what to do. A fund manager would die of fright if he was put in charge of a shipbuilding company. These people entrust capital to management teams that do know how to run cement plants or shipbuilding companies. But if you put yourself in the position of one of these active managers of capital, a decision maker at a company, there is a simple rule that guides every single decision that you ever make, every day of every week. And that is that the return on capital be greater than the cost of capital. This is the E equals MC squared of all corporate decision making. Ever since the June 1958 Nobel Prize for Economics, actually the Nobel Prize was 30 years later, I don't know why that always happens, but ever since June 1958, that's what it's all been about. Now, it's very easy to explain, but it's nearly always misunderstood. And let me demonstrate the misunderstanding. Let us suppose that I am the chief executive of this company and you are my shareholders. In other words, I'm meant to be running this company to generate value for you. Under my brilliant management, everything that we ever do has a return on capital of, let's say, 11%. I mean, obviously this is impossible. Every decision has a different return. But let's, as a classroom hypothesis, suppose that by some miracle, everything I ever touch turns into an 11% return. But let us suppose that the so-called cost of capital is 14%. That means, under my management, we appear to have it the wrong way round. We've got 11% playing 14%. And this goes on week after week, month after month. What do you think is going to happen in due course to this company if week after week, month after month, we have a return on capital which is materially and consistently below the cost of capital? Now I'll pause there to give you a moment to think about the question that I've just asked. There's a fairly good chance that you have concluded that the company is going to get into financial difficulties. And if you are thinking, and the answer is no, bankers love these companies, by the way. The reason that you may have been thinking that this company is going to get into financial difficulties is because of the misuse of language. When I first started to do training courses many years ago, and for the first time I had to explain to people as opposed to just getting on and doing your work, I asked myself, why is it that you see so many people from different backgrounds, different companies, but when they do quantitative analysis, you always see them make the same mistakes? And you know, I think I've cracked it. It's the misuse of language. If you mean price, say price. If you mean value, say value. Someone who says realizable value is nonsense. Realizable means price. Price value is nonsense. If I hear someone say equity IRR, I know they're going to calculate it wrong. If I hear someone say weighted cost of capital, I know they're going to calculate it wrong. Back in 1958, they should never, ever have called it the cost of capital. Because if you call it the cost of capital, I know what goes on in your mind. You translate the word cost into cash. And it's very clear. If I had $11 of cash coming in and $14 of cash going out, it's not sustainable. I will become illiquid. And if I don't get on top of it, I will become insolvent. Please understand that the cost of capital has nothing whatsoever to do with what your capital actually costs you. That's not what it is. There is a correlation between risk and return. The more risk to which you are exposed, the more return that you should want. And so what they should have called the cost of capital is the minimum required return. It's the pricing of risk. How much return do you want to compensate for the risk to which you are now exposed? And by risk, we don't mean solvency risk, we mean volatility risk. I think intuitively you would know that an airline tends to have a volatile cash flow. It's business and tourism travelers, it's very cyclical. You've got event volatility, during the SARS epidemic, and of course during the coronavirus epidemic, people aren't flying. That's volatility to their cash flow. You fly an aircraft into a mountainside and see what that does to your cancellations to bookings ratio. So you have a volatile and therefore high risk cash flow. I want a higher return. Whereas if I invest in Carrefour or Tesco or a supermarket, I think intuitively you'd know they have very stable, relatively stable cash flows, and therefore low risk, low volatility. I don't need such a high return. So assuredly, this company is not going to get into financial difficulties. But on the other hand, it is now revealed that the return that is being generated from this decision falls well short of the return required to shareholders. In other words, if you like, it's value destroying. It doesn't give them the return that they should want. Well, if I'm the chief executive and I keep doing this repetitively, the return is below the reasonable expectation of the shareholders. What are you, the shareholders, going to do about it? Now again, we don't have interactivity in this video, but I am sure you're going to tell me you want to do one of two things. You either want to sack me, i.e. get rid of me, replace me with somebody who's going to manage the franchise more effectively, or you're going to sell your shares and take your capital, take your money elsewhere. Well, let's go through each of those. If you decide to sack me because I'm not delivering the returns you require, you're assuming that this is bad management. And it might be. And of course, if it is bad management, addressing that, replacing the management might be a factor you will consider. But this could be brilliant management. This could be a textiles plant in Western Europe competing with cheap Chinese labour. Any other management team, and you'd only get 7%. You're only getting this 11% because of my brilliant management. Or this could be a shipbuilding company in Western Europe competing with Korea and Taiwan. All of the other shipyards are bankrupt. Mine is still going because of brilliant... In other words, this diagram is ambiguous as to whether the management is good or bad. If this business is a so-called legacy industry, a sunset industry company, as opposed to the sunrise industries that we're always talking about, this is what it looks like. This is US Steel here. This is the Ford Motor Company, where the competitive advantage moved away decades ago. But these companies aren't going to go out of business. They're very slow growing. Remember in a previous clip I said big fat boring companies can glide and glide for years. They are very strongly cash generative and they have high dividend payouts, not young thrusting high growth companies. As a generalization, of course. So, as I say, this diagram is ambiguous as to whether the management is good or bad. Let's imagine that the management isn't bad. In other words, changing management won't achieve anything. Okay, so you're going to sell your shares. Well, if at the margin more people are selling shares than buying, in other words, the supply-demand, then all other things being equal, the share price will underperform. I'll just draw it as an arrow going down. Now, let me pause here before somebody calls me a hypocrite, because in a previous clip I said that price and value are two different things. There's no reason why at any particular moment in time price and value should be in alignment. I now seem to be saying something different. I'm saying that value is negative, because the 11 plays 14 here, and the price will follow it down and be negative. In other words, price and value are perfectly correlated. Well, remember in the previous clip, I never said that value was irrelevant to price. I said value was a driver of price, not the driver of price. That's the difference between perfect markets and the real world. In reality, even though value is now acting as a negative influence on price, in real life there could be all sorts of other influences that could be sending it back upwards or sideways or so on. All I'm doing in this diagram is airbrushing out of the picture any of the other price drivers. And I'm saying that to the extent that value is driving price, it's acting as a negative driver to that price. Okay, why does the price not go to zero? Because the return on capital is not 11%. The return on capital is X million dollars. And as the investment becomes a cheaper investment, X million dollars represents a better return. In other words, any investment is a good investment as long as you get it cheap enough. Now, let me restate that. any investment that has a positive return, there is a price at which it once more represents a good investment. So, this diagram, now completed, represents the foundation principles for corporate valuation.